At the end of January 2026, gold fell 8.2% in just 4 hours. It was the biggest intraday drop in precious metals since 1980. And while all this was happening, the silver was plummeting along with it. More than 14% lost before lunch. All this on a typical market day. No war, no recession announcement, no natural disaster. What few people understood is that this movement was triggered by a single decision, a decision directly linked to the Federal Reserve. And even more deeply connected to Donald Trump. This is not theory, it's fact. It is documented in minutes, in prices, and in positions unwound by global funds. It's the kind of event that changes the course of the market for years, and that almost nobody notices at the time. Most people are distracted, thinking it was just a technical scare. But by the end of this video, you'll understand exactly what the hidden risk is. Why doesn't he leave sooner? And what the big players are already doing behind the scenes. You'll see the pattern that almost no one else is noticing. And most importantly, it will help you understand what stage of the cycle we're in. Because in cycles like this, understanding later is the same as losing now. The market opened calmly, no relevant data on the agenda, no new conflicts on the radar. But at 9:18 a.m., the gold chart began to plummet. In less than 45 minutes, the metal lost almost 7%, dragging silver down with it, which melted more than 10% in a matter of minutes. It was an abrupt movement, without headlines, without rumors, a deafening silence on the institutional desks. And that's precisely where everything begins to change. It wasn't a typical correction. It was violent, coordinated, and out of the ordinary. Gold doesn't usually move with that kind of intensity except in extreme events. But on that day, there was no disaster. There was no war, just a subtle change in the leadership of an agency. What seemed small wasn't. It was the spark that ignited a fuse that had been building up for months. Experienced traders began issuing private warnings. This is not retail flow. And in fact, it wasn't. It was something bigger, colder, more calculated. The orders came in blocks. They were leveraged. They had a target. American bank trading desks were urgently dismantling positions. This only happens when some information is changed, even if the market hasn't noticed it yet. Throughout the morning, liquidity dried up. Slippage increased. Brokerages began to freeze metal trading. In the financial Twitter world, panic set in. But among insiders, the mood was not one of panic. It was an execution phase. Someone was reallocating billions of dollars. And the question that echoed among the few who noticed the movement was, why now? The answer didn't come from a headline. It came from an appointment. Minutes before the opening, a document had been filed in the U.S. Senate. The new composition of the Federal Reserve Board has been formalized. Among the names is one personally nominated by Donald Trump with a history of political interference in monetary policy. This is the detail that almost no one noticed. That's exactly where it all began. The timing was no coincidence. Behind the scenes, the most astute managers were already aware of the risk. But they needed formal confirmation to act. And when it came, the robots did the rest. The logic was simple. If the Fed loses independence, future real interest rates need to be repriced. And if real interest rates rise, precious metals, which are a store of value, lose traction. What seemed irrational was actually just the market adjusting prices to the new risk. Gold fell, silver plummeted, but that wasn't the most important thing. The crucial detail is that no one intervened. No pronouncements, no warnings. The Fed remained silent. The Treasury remained silent. And this silence is worth more than 1,000 statements. It's the kind of silence that the market interprets as permission to continue selling. And perhaps the most overlooked aspect of the week was the behavior of sovereign wealth funds. In the days following the collapse, no central bank announced replacement purchases. Conversely, some Asian reserves have discreetly reduced their gold and silver holdings. This is the kind of move that will never make the front page of Bloomberg, but it determines the course of trillions of dollars in the coming months. Those who understood what happened that day are well positioned for what comes next. Because the market didn't fall by accident. It fell because something went out of price action. Most retail investors thought it was panic. But those who follow institutional processes saw something else. Sales began quietly, without panic, without hysteria. Big players were dismantling positions with method and surgical precision. It was a risk repricing, not emotional, structural, and that changes everything. What happened was a violent adjustment of future expectations. The decision linked to the Federal Reserve triggered a new variable in the mental model of the funds. They weren't selling gold and silver because of the gift, but because of how political risk has distorted the future logic of monetary policy, the detail that almost no one notices. It wasn't a sale, it was a mathematical realignment. On days of panic, the volume explodes with noise. But that morning, volume exploded as algorithms executed programmed orders. Quantitative models automatically cut positions upon identifying parameter deviations. Prices triggered stop losses on leverage strategies, and the domino effect made it seem like panic, but it was calculated. The largest global macro funds reacted almost simultaneously. Bridgewater, Man Group, Renaissance, all with a history of operating based on probabilistic models. And the models are clear. If the Fed is no longer neutral, safe haven assets need to be reevaluated. This includes precious metals, dollar futures, and even the real yield curve of the United States. In other words, it wasn't just the price of gold that fell, it was an entire thesis that was taken off the price. The leverage structure had been in place for months. Many funds were buying gold as a hedge against inflation and fiscal instability. But this protection had one condition: the independence of the central bank. When this pillar shakes, the models tell it to slow down. It's automatic, and that's why the fall was so quick, because it was all already planned. Repricing didn't choose a time or place. European markets began to react within the first 2 hours. Gold is falling, silver is falling, metal ETFs are losing liquidity, and once again, the behavior of the central banks was one of strategic silence. A silence that says, let the market adjust. Meanwhile, the media only talked about technical adjustments and profit-taking, but insiders were reading between the lines. This decision was not technical, it was political. And the market is repricing the risk of political capture of the Fed. This is where the story changes completely. If it were just panic, there would have been a reversal the next day, but it didn't happen. Not the following week, not the following month. This shows that it wasn't just noise. It was a fundamental change. The models have changed, the projections have changed, and when the models change, the money goes with them. That's the difference between those who react to the headline and those who understand the invisible mathematics behind the flows. And this math points directly to what started it all. The Fed's decision that lit the fuse, and that's what we're going to explore now, the Fed decision that ignited the fuse. The last straw was an appointment, simple, dry, and without fanfare. On January 15th at 7:42 a.m., the White House has officially confirmed a new name for the Federal Reserve Board, a nominee directly appointed by Donald Trump with a history of criticism regarding the independent operation of the central bank. This sounds technical, but it was the trigger the market needed to turn around. The nominee was no ordinary person. He was a former campaign advisor, known for openly advocating negative real interest rates and for suggesting that the Fed should respond to the will of the people, read to the presidency. That phrase, uttered months earlier, seemed like political rhetoric. But with the official appointment, it became a real risk. Up until that point, the market had been betting that the Fed would at least maintain its facade of neutrality. Even with Trump returning to power, the central bank was expected to resist. But this appointment shattered that expectation. It was a clear sign of direct political interference in the conduct of monetary policy. And the market knows what that means. Instability at the heart of the system. The most worrying thing wasn't the name, it was the context. The appointment came at the exact moment when the Fed needed to contain inflation expectations. In other words, at the worst possible timing. Instead of reinforcing credibility, the decision undermined market confidence. And this has devastating consequences for sensitive assets like gold and silver. Behind the scenes, political consultants warned fundraising funds that other similar names would emerge. A potential pro-government majority on the Fed board had been discussed off the record since December, but this confirmation turned speculation into reality. And when that happens, quantitative models come into play. Because the risk, which had been latent, was now on paper. The detail that few people noticed is that this appointment was preceded by an executive order. A subtle change in the nomination criteria, authorizing the president to nominate individuals with proven political experience. This loophole paved the way for the current movement. And the market, noticing this, understood that it was not a common exchange, but rather a change of institutional course. The reaction was almost instantaneous. Future real interest rate curves have shifted upward. Long-term bond yields began to rise within minutes. And with them, the valuation models for metals began to implode. The math doesn't lie. With real interest rates rising, inflation hedging becomes less attractive. And here's a crucial point. Gold didn't fall because it lost value. It fell because it lost its protection. The built-in protection against extreme risks was, until then, based on blind faith in the Fed. And that trust was officially broken. Now, the market faces a classic dilemma. Believe the public narrative or follow the silent signs. And the signs point to something clear. The risk that was embedded in the price is gone. What many failed to understand is that the collapse in prices was not caused by a new risk. It was caused by the removal of an old one. A risk that, until then, was embedded, priced in, accepted as constant. That risk was the independence of the Fed. And, the moment that questioning began, the price of protection plummeted like a stone. For years, the market has priced gold and silver with a hidden premium. The belief that, in the event of a crisis, the Federal Reserve would act technically, not politically. This was the invisible shield that supported the metals as a structural store of value. But with the new appointment, that shield cracked. And when the implicit protection disappears, the asset loses value. The Fed, since its founding, has lived on one thing: credibility. When the market believes that monetary policy will be neutral, the models are able to project future inflation, real interest rates, and exchange rate behavior. But if this neutrality is captured, all of this enters a zone of turbulence. and defensive assets need to readjust urgently. The detail that almost no one noticed is the fall of the metals. It was not proportional to the change in the macroeconomic scenario. It was disproportionate precisely because the political risk was no longer priced in. For years, this risk was ignored because it seemed unlikely. Now he's back, and with a vengeance. The logic is simple. The more political the Fed becomes, the more unstable the dollar, the more it remains as the global reserve currency. And the more unstable the dollar becomes, the more central banks begin to recalculate their reserve diversification. This directly affects the flow of gold purchases by official institutions, and this is one of the silent forces that sustain the bull market in metals. Analysts who only look at inflation, GDP, and unemployment are missing the bigger picture. The issue here is not macro, it's institutional. Doubts about the Fed's neutrality change the whole game. It alters the perceived value of the currency, the future discount rate, and confidence in the system. And this can't be solved with an interest rate cut. It's much deeper than that. The reality check was harsh. The prices of gold and silver had more faith in the system than the market admitted. And that faith was eroded in a matter of hours, not because gold has ceased to be valuable, but because the world stopped believing in the referee of the game. What went down in price wasn't just the technical protection, it was a feeling of predictability. The investor who once slept soundly with their metals hedge, now we need to consider the risk that monetary decisions are being dictated by political agendas. This is the kind of risk that has no formula, only escape. And while this structural risk was being factored into the price, other risks, which never disappeared, remained strong. Deficits, inflation, and geopolitics are still very much alive. The fall in the price of gold and silver has led many to believe that the worst is over. But that interpretation is dangerous and naive, because while the market was repricing the institutional risk of the Federal Reserve, the fiscal, inflationary, and geopolitical risks remained exactly where they were, at the center of the global machine. The United States' fiscal deficit continues to grow at an unsustainable rate. In 2026, the deficit in public accounts already exceeded $2 trillion per year. And the detail that few notice, most of this deficit is no longer cyclical. It is structural, embedded in permanent programs such as Social Security, health, and defense. In other words, it's not something that goes away with growth. It's embedded in the machine's backbone. Furthermore, inflation has not yet been brought under control. Even with adjustments to the interest rate, core inflation remains above the target, and the inflation that remains is no longer from commodities or energy. It's from services. This type of inflation is sticky, difficult to combat, and corrosive to any asset based on monetary trust. Meanwhile, geopolitical risk is reaching its highest level since the Cold War. The invasion of Venezuela, the tension in the South China Sea, the rumors about Greenland, all of this creates an environment of uncertainty where institutional investors need to protect themselves. And historically, this protection has always come from precious metals. Even with the recent correction, their strategic role remains intact. And there's more. Central banks around the world haven't stopped buying gold. Unlike retailers, who are panicking, reserve managers are quietly accumulating assets. Diversification of reserves, protection against the dollar, inflation hedging, these are the reasons. Their behavior shows that the structural theory of metals still holds true, and perhaps stronger than ever. What decreased was the excess, the security premium embedded in an exaggerated belief in institutional stability. But the long-term fundamentals, deficit, persistent inflation, global risk, these people continue to put pressure on the system, and nobody has a magic solution for them. If the market were truly confident in fiscal control, long-term U.S. bond yields were supposed to be rising, but they aren't. What we see is an unstable curve, full of distortions, indicating that the market itself is suspicious of the debt trajectory, and when the market becomes suspicious, some metals return to the table. Therefore, the phrase, "gold is dead," is a trap for the unwary. He didn't die, he just adjusted his price to the new type of risk. The protection that was previously against technical instability is now being applied against fiscal collapse. The enemy has changed. The battle continues. Understanding this change is essential to knowing what to expect going forward, because the stage is still set. It's just changed phases. Why this isn't the end of gold and silver. When the price of gold falls, the headline is always the same: end of the era of precious metals. But history shows otherwise. Almost always, major falls precede new reassessments. After all, we're talking about assets that have existed for 6,000 years as a store of value. What we saw now was not a structural collapse. It was a change of direction in the engine of appreciation. And that changes everything, especially for those who look to the long term. Previously, what drove the price of gold was the fear of the Fed making technically wrong decisions. Now, the structural deficit of the United States is coming into focus. In other words, the focus shifted from the short-term interest rate to the fundamental issue. For how long can the dollar be issued without limit and without consequences? This is the new game. And metals remain the preferred form of protection in this scenario. Silver, in turn, also remains firmly in its dual role. In addition to being a financial asset, it is a high-value industrial input. Technological demand continues to grow: electric cars, solar panels, military chips. Despite the recent drop, the centuries-old silver cycle has not been broken. The correction was technical, not structural. The detail that almost no one notices is that the long-term buyers didn't sell. Central banks continue to accumulate gold. Even though they remain silent, sovereign wealth funds continue to run repurchase algorithms. What emerged were leveraged positions, short-term bets, headline players. Those who understand the fundamentals remained silent and maintained their position. Another point overlooked: metals fell in dollar terms, but they didn't fall with the same force in other currencies. This shows that the movement was not exclusively against metals, but a specific repricing of the dollar in light of its own political landscape. In other words, the asset continues to function. It's just adapting. Gold and silver are like sensors of systemic trust. When the system inspires stability, prices fall, but when structural weakness appears, and it always does, metals respond. This dynamic is cyclical, and it has happened countless times throughout history. We are simply repeating the same pattern once more. The fundamentals remain: growing deficit, resilient inflation, silent currency war, central banks are moving away from dollarization, real assets returning to the center of the global protection strategy. Therefore, to say that gold and silver are dead is to ignore 2,000 years of monetary history. They've simply changed stages, and investors who understand this are already repositioning themselves. It's not the end, it's the beginning of a new phase. And the next move depends on a single factor: the behavior of inflation. Therefore, in the next topic, we will explore exactly that: the three likely scenarios from here on out, and what each of them means for precious metals. The movement of precious metals now depends on one key variable: the trajectory of real inflation. It is this that defines the behavior of real interest rates, and therefore the value of gold and silver as a hedge. The recent correction did not invalidate the thesis, it merely redefined the battlefield. From here, three scenarios gain traction, and each one points to a different outcome. Scenario 1, persistent inflation. If prices remain pressured above the target, even with weak growth, the Fed will have to choose between raising interest rates or accepting currency depreciation. In this scenario, gold returns to the center as a primary inflation hedge. History shows that when interest rates fail to keep pace with inflation, the price of gold rises in waves. And this could be the next cycle. Scenario 2, inflation eases slowly. If prices start to fall gradually, the market enters consolidation mode. Gold and silver stabilize. This is a sideways trading environment with peaks of opportunity. Institutional funds tend to accumulate positions discreetly, without haste. It's fertile ground for those who know how to buy cheap and wait. Scenario 3, inflation accelerates again. Here lies the explosive trigger. In the event of an external shock, such as oil, war, or a fiscal crisis, if prices get pushed up again, the Fed would be in check. Real interest rates could fall even with inflation rising. And in that environment, the metals explode again. The detail that few people notice is that in all scenarios, gold remains relevant. What changes is not the thesis itself, but the speed at which it manifests itself. Those who understand this avoid selling at the bottom and know where to reposition themselves, because the market doesn't move solely based on data. It moves based on perceptions of future risk. Another critical factor is the behavior of Asian central banks. If they maintain their course of diversifying reserves, as they have been doing since 2020, this creates a structural base demand for gold independent of the inflationary scenario. This demand doesn't make headlines, but it generates billions of dollars per quarter. Furthermore, the tension between Trump and the Fed itself has not yet ended. The appointment we witnessed could be the first of many. If the market perceives a complete political capture of monetary policy, metals are back in the game, not as a hedge against inflation, but as protection against institutional instability. Therefore, trying to predict the exact future is an illusion. But mapping out the possible paths is power. And those who already understand these three scenarios are able to make decisions outside the herd. Because when the market sets the direction, metals don't give warnings, they react. Now that we know what can happen, the most important thing remains to be understood: what you, as an investor, really need to see right now. What investors need to understand now. What separates those who lose from those who prosper in these cycles is not luck. It is a deep understanding of the dynamics of value. And the central point is simple. Gold and silver don't respond to headlines. They respond to real interest rates. This means that the investor's focus cannot be on the noise, but on the structure. And the structure still favors those who understand the long-term game. The most common mistake now is selling because the market is falling. But the market hasn't ended. It's repositioning itself. Whenever the fundamentals remain strong but prices fall, what we have is a rare window for strategic relocation. And that's exactly what institutional players are doing right now. Another point overlooked: political decisions affect the timing, not the structural logic. Trump's appointment has indeed disrupted the short term, but the United States' fiscal problems, persistent inflation, and geopolitical risk remain. These are the real drivers of the appreciation of precious metals, and they don't disappear with a price drop. The investor who understands this protects themselves from two fatal mistakes: impulse buying at the top, selling at the bottom out of fear. Instead, he does what central banks are doing. It accumulates discreetly, adjusts its course, and waits for the next stress cycle to harvest. Furthermore, it is crucial to understand that the market is self-correcting. If the Fed continues flirting with politicization, the market will punish that decision. With the devaluation of the dollar, a rise in long-term bonds, and a return to gold as a safe haven. That's how cycles close. It always has been. Therefore, the question is not what will happen to the gold. The right question is, what is changing in the macroeconomic background that affects the logic of real assets? If you have clarity on this, you will be light years ahead of most people, because the market only seems irrational to those who cannot see the invisible flows. In each cycle, the system attempts to preserve its appearance of normality, but the fundamentals always reappear. And the real assets, gold, silver, land, commodities, they always return to the spotlight when the illusion ends. The only question is, will you be positioned when that happens? This is the reflection that distinguishes those who merely observe from the window, of those who build real wealth during the shocks. Because in this game, understanding now is different from understanding later, and those who understood are already preparing for the next move. History is repeating itself. Again, names change, faces change, positions change, but the pattern remains. Excessive debt, monetary instability, political risk, and finally, the desperate rush for real assets as protection. The fall in gold and silver prices is not the end of the cycle. It's just a pause. The foundations continue to accumulate silently, like tectonic plates before a tremor. And those who understand this now have an advantage that most will only realize too late. Do you prefer to wait for the next shock, or to position yourself before it comes? Is it accumulating headlines or real assets? Are you betting on politics or on scarcity? Remember, understanding is different from acting. And most who understand, too late, pay the price in assets, time, and opportunity. Therefore, if this content helped you see the situation more clearly, subscribe to the channel now, turn on notifications, and leave a like. This shows the algorithm that you value this type of analysis that goes beyond the surface. And in the next video, I'm going to show you how central banks are redesigning the new global monetary architecture. And what does this mean for the dollar, gold, and the next 10 years of your money?